Welcome back to Cool Trade University. This is Gene Guarino. We're continuing with our series on stock market terms and definitions. This is not meant to be an exhaustive training, just an introduction to these terms. I want you to have a little familiarity. If you catch it on the first time through, terrific. If not, feel free to watch it again and again. And again, not an exhaustive training, just an introduction. So let's go right into what's called MACDs, moving average convergence and divergence. Now we call them MACDs. Some people say MACD, but MACD is what they're commonly known as. They were developed by Gerald Appel in the late 70s, and the moving average convergence and divergence MACD indicator is one of the simplest and most effective momentum indicators available. The MACD turns two trend following indicators, or moving averages, into a momentum oscillator by subtracting the longer moving average from the shorter moving average. As a result, the MACD offers the best of both worlds, trend following and momentum. The MACD fluctuates above and below the zero line as the moving averages converge, cross, and diverge. Traders can look for signal line crossovers, center line crossovers, and divergences to generate signals. Because the MACD is unbounded, it's not particularly useful for identifying overbought or oversold levels. The MACD line is the 12-day exponential moving average, or EMA, that we just described in the last section, less the 26-day EMA. Closing prices are used for these moving averages. A 9-day EMA of the MACD line is plotted with the indicator to act as a signal line and identify turns. The MACD histogram represents the difference between MACD and its 9-day EMA, the signal line. Now the formula that you see there, whether you catch that all or not, it's actually pretty simple, but that's what's being done by the computers and again by Cool Trade robotically for you. The histogram is positive when the MACD line is above its signal line and negative when the MACD line is below its signal line. The values of 12, 26, and 9 are the typical settings used with the MACD. However, other values can be substituted depending on your trading style and goals. Now, as its name implies, the MACD is all about the convergence and divergence of two moving averages. Convergence occurs when the two moving averages move towards each other, and divergence occurs when the moving averages move away from each other. The shorter moving averages, the 12-day, is faster and responsible for most MACD movements. The longer moving average, 26-day, is slower and less reactive to price changes in the underlying security. The MACD line oscillates above and below the zero line, which is also known as the center line. These crossovers signal that the 12-day EMA has crossed the 26-day EMA. The direction, of course, depends on the direction of the moving average cross. Positive MACD indicates the 12-day EMA is above the 26-day EMA. Positive values increase as the shorter EMA diverges further from the longer EMA. This means upside momentum is increasing. Negative MACD values indicates the 12-day EMA is below the 26-day EMA. Negative values increase as the shorter EMA diverges further below the longer EMA. This means downside momentum is increasing. In this example, the yellow area shows the MACD line in negative territory as the 12-day EMA trades below the 26-day EMA. The initial cross occurred at the end of September. You can see it with the black arrow. And the MACD moved further into negative territory as the 12-day EMA diverged further from the 26-day EMA. The orange area highlights a period of positive MACD values, which is when the 12-day EMA was above the 26-day EMA. Notice that the MACD line remained below 1 during this period. You can see it with the red dotted line. This means the distance between the 12-day EMA and the 26-day EMA was less than 1 point, which is not a big difference. The MACD indicator is special because it brings together momentum and trend in one indicator. This unique blend of trend and momentum can be applied to daily, weekly, or monthly charts. The standard setting for MACD is the difference between the 12 and 26 period EMAs. Chartists looking for more sensitivity may try a shorter short-term moving average and a longer long-term moving average. MACD of 5, 35, and 5 is more sensitive than a MACD of 12, 26, and 9 and might be better suited for weekly charts. Chartists looking for less sensitivity may consider lengthening the moving averages. A less sensitive MACD will still oscillate above and below zero, but the center line crossovers and signal line crossovers will be less frequent. The MACD is not particularly good for identifying overbought and oversold levels, even though it's possible to identify levels that are historically overbought or oversold. The MACD does not have any upper or lower limits to bind its movement. And during sharp moves, the MACD can continue to overextend beyond its historical extremes. Finally, remember that the MACD line is calculated using the actual difference between the two moving averages. This means MACD values are dependent on the price of the underlying security. The MACD values for a $20 stock may range from down $1.50 to up $1.50, while the MACD values for a $100 range may be minus $10 to plus $10. And it's not possible to compare MACD values for a group of securities with varying prices for that reason. So there's your introduction to MACDs, moving average, and convergences and divergences. We're continuing on with our series here on stock market terms and definitions with Cool Trade University. Stay tuned for the next.